This is Concrete Numbers, where construction meets accounting, tax, and business strategy. I'm your host, George Kazarian. If you're ready to scale your construction business and master your finances, this is the podcast for you.
Hey everyone, welcome back to the show. In today's episode, I want to talk about the new depreciation rules under the OBBBA that got passed here just a few months ago. There's been some major changes to both depreciation and expensing, and that's what I want to go over today. So with the new rules, you can write off the full cost potentially of large purchases like trucks, equipment, and buildings. Depreciation has always been one of the best tax tools for contractors, and I'll get into that in a sec. And bonus depreciation helps accelerate a lot of, the expensing of those purchases, whether you actually paid for it in full or not. So the key change is that 100% bonus depreciation is back, and it's made permanent, starting with purchases effective, January 2025. No more phase outs or sunsets. However, there are some important deadlines. For general assets like vehicles and equipment, they have to be placed in service prior to January 1, 2030. For long production assets, like machinery or equipment that takes a long time to construct, these are like custom built machinery and equipment, the deadline is January 1, 2031. And funny enough, plants or trees can also be depreciated. This is, usually more in agricultural line of business, and the deadline for that is January 1, 2030 as well. Now, the OBBBA introduced a new concept called qualified production property. And what that is non-residential real property that's used in constructing tangible goods or refining. For example, if you have a fabrication shop, an asphalt producing plant, or some sort of manufacturing plant that produces some sort of goods that are used in construction, you could effectively bonus depreciate, expense 100% of the building of that property like upfront in that year of purchase. That's the advantage with QPP. It allows for that immediate depreciation in the year of purchase, which was something that, wasn't really allowed before. Things that unfortunately wouldn't qualify as QPP are office space, parking lots, administrative area, lodging or employee housing, sales and showrooms, things like that. Those wouldn't qualify. It would need to be the building related to, the production of some sort of like a good, an actual tangible product. Storage only facilities. Also, the building of, say, intangible products wouldn't qualify as well, say R&D, software expenses. It needs to be a building used in actual production, like, steel, concrete, mixing things, fabricating components. Also, one more caveat is that property needs to be original use by you. It can't be purchased secondhand or, have been used by somebody else and you purchased it. It also needs to be actively used in the business. Now, if you didn't exactly purchase a property and make a building on it for production purposes, there is still hope for 100% bonus. What you could do is actually, have your non-residential real property, whatever it's used for, your construction business, you can actually go get a cost segregation study done. You're going to have to, pony up a couple grand or whatever it is. You'd have to discuss the fees with whoever's, licensed to do it. It's like an engineering report. Engineering/accounting, and anyways, this cost segregation study would be done, and any asset on the property that is under a 15-year life, or sorry, a 20-year life, is going to qualify for 100% bonusing. Now, let's read some examples of what types of properties can qualify here. I'm going to put it down on the screen. So one type is land improvements. These are assets outside of the building structure, like paving, asphalt, curbing, gutters, parking lots, lighting, site lighting, fencing, gates, retaining walls, landscaping, that kind of thing. These are all eligible for 100% bonus, assuming you get a cost segregation study done. Specialty electrical and plumbing systems. These are usually 5 to 7 years. It's under our 20-year threshold. And these as well. These are, eligible for 100% bonus. Examples, dedicated electrical system for machinery, compressors, specialized plumbing for manufactured or fabrication equipment, compressed air systems, piping or water lines. Interior finishes, these are usually 5 to 7 year life, and these would qualify 100% bonus as well. Carpeting, cabinetry, removable partitions, specialized flooring, built-in equipment, that kind of thing. HVAC, ventilation, specialized systems, things like that, usually 7 to 15 year life, we get 100% bonus. Certain fixtures and equipment, like shelving, security systems, pretty much like everything outside of the land and building, most everything would qualify for 100% bonus again. That could be, a very significant amount. It's not little to say the least. Cost segregation study is something you only need to do once. It's not like you need to go update it every year unless you went and bought a whole new property or something. But for any given property, you really just need to do it once. It is possible to do it, after, you've actually purchased the property, like in a later year. It would be a little messier accounting-wise, however, it could be done. Something I covered in my last episode, however, we'll recap again because they're kind of interrelated, so we talked about this QPP, like these few other asset classes. However, another big one is vehicles. Anything greater than 6,000 pounds, it's basically eligible for 100% bonus depreciation. Anything under 6,000 pounds, there are caps. It was basically 20,200 for 2025, 19,600 for 2026, 11,800 for 2027, and $7,060 for every year thereafter until it's fully depreciated. So the under 6,000 vehicles are capped year over year. However, greater than 6,000, you could pretty much bonus depreciate it right away in the year of purchase. We went over real property, we went over vehicles. Now one more, asset class, like let's just give an example, like an excavator. If you were to buy this heavy machinery and equipment like an excavator, let's say you bought it for $400,000, pretty much it would qualify for bonus depreciation. So that's really nice in that, you finance this or purchase this excavator for $400,000, and that year you get to deduct that full $400,000, even if you haven't paid, the note related to it, like over, let's say it's a 5-year note or something. You still get that $400,000 deduction. So that's pretty much it. This is big. It's big news. Things were capped very much so prior to this. It definitely wasn't 100% in 2024. In 2024, it was 60%, and it was planned to go down, every year, 20% until 0 in 2027. So this has definitely been a big, game changer in tax planning. It definitely gives us an extra tool to work with. Again, timing is everything. You obviously want to make sure you buy your, equipment, everything between 2025 to 2030. It's 100% through all these years. And who knows what administration will do what in the years after that. But this will help, obviously, cut your tax bill, improve cash flows. Hopefully you reinvest that extra capital. That's kind of the intent of the whole bill. I hope this has been helpful. Hit like, subscribe, turn on notifications for any tax updates. You can always go down to the show notes for basically a summation, like a transcript of the notes of this show. And also, if you have any questions, feel free to book a time as well.